What exactly is the idea behind risk and return in investing? Dive into the world of investing and you'll hear this buzz phrase: the greater the risk, the greater the potential return. It rolls off the tongue of finance gurus with the same frequency as baristas at a Portland coffee shop, asking if you want your coffee fair trade and organic. But what does it really mean? In essence, when you invest, you're essentially putting your money on the line, hoping to see it grow over time. However, as with any bet, there is the chance things might go south. This is where the concept of risk comes in. Risk is that ever-present possibility that your investment might falter, causing you to lose some or even all of your invested capital. Now let's talk return. The return is the sweet, sweet profit you aim to make from your investment. It's the reason we're all playing the game. The two go hand in hand like hipsters and IPAs because typically, in order to entice an investor to take on more risk, the potential return must also be higher. Picture this. You've got a savings account with reliable, yawning returns, basically next to nothing. It's like planting a garden in the backyard of your Portland home and just growing kale. Sure, it's safe, unless there's an unexpected kale blight, but it's not going to be very exciting. Now, on the flip side, investing in a startup or the stock market can be akin to planting an exotic fruit that could either be the next big superfood or completely fail to thrive in Oregon's temperamental climate. It's a riskier endeavor, but if it pays off, you could be raking in returns that are the talk of the neighborhood. Risk and return are also about finding balance. We're not all evil Knievels looking to jump over Snake River Canyon on a rocket. Some of us prefer the scenic bike path down by the Willamette. So when investing, you need to assess your own risk tolerance. Are you okay with the roller coaster of high-risk investments, or do you prefer a more steady, leisurely financial growth? Finding your sweet spot on the risk-return spectrum is key. It requires introspection and sometimes a willingness to learn from mistakes. Because let's be real, even the most meticulous Portland brewmaster occasionally ends up with a batch of beer that tastes more like the Willamette than the complex IPA they planned. Understanding your risk appetite and investments. Think of your investments like a menu at a groundbreaking Portland food cart. You can go for the dish that everyone's raving about but might give you indigestion, high risk, high return, or the tried-and-true sandwich that's satisfying but won't be the most memorable meal you've ever had. Low risk, low return. Remember to diversify your investments like a well-rounded menu too. Don't put all your eggs, or tofu if you prefer, in one basket. A balanced portfolio may not make you the Warren Buffett of the Pacific Northwest, but it can help protect you from financial upset stomachs and preserve your capital for future investment feasts. In the end, risk and return are the yin and yang of investing. They'll keep you on your toes and hopefully lead you to make decisions that result in a well-fed retirement account. And just like we Portlanders enjoy our rainy days knowing they bring the lush landscapes we love, an investor learns to appreciate the risks for the green returns they can bring.